So let's start at the beginning. Back in the 1800s through to the 1840s, banks at that time actually had the ability to create money. And the way they did this was through printing pieces of paper. When you put your coins into the bank, they give you a receipt. And that receipt would say you've deposited £5. And because it was more convenient to carry bits of paper around than to carry metal coins around, people used to use the pieces of paper as though they were money. They'd actually spend the paper in the shop. And so long as the shopkeeper knew the bank and trusted the bank, he'd accept the paper. So basically, the pieces of paper that banks were issuing were treated as money, and they became as good as money. Now, when the banks caught onto this, they realized that actually, if we just issue more pieces of paper with sums of money written on them, and people treat them as money, then effectively we have the power to create money. So the more that we issue, the more we can lend, and the more we lend, the more interest we get. So you can imagine with incentives like these, it didn't end well. They created too much money, and it started to cause instability in the economy. It caused banking crises. And after a number of years of this happening, the government of the day, so it was a Conservative Prime Minister, Sir Robert Peel, stepped in and said, well, we can no longer allow banks to issue paper money because of the problems that it's causing in the economy. So they passed this piece of legislation, the Bank Charter Act, which said from this point on, only the Bank of England will have the authority to create paper money. But they missed something out, because paper money isn't the only way that you can make payments. And with the increasing use of checks, people had a way of making payments using the numbers that were in the ledger books of the banks, the accounting entries. So they had this way of making payments without actually needing the real paper or metal money. Over time, as we discovered electricity, we got debit cards, electronic fund transfers, and internet banking. To the point now where more than 99% of all the money that changes hands does so electronically. The shocking thing is that even though our monetary system now is electronic, this law has never been updated since 1844, which means that it's just shy of 170 years out of date, the law that actually governs our monetary system. Now, the reason that banks can create money is because the liabilities, the accounting entries that they create, are what we are using as money. When you make a debit card, you're not using, there's no £10 notes moving from your account to somebody else's account. It's actually just accounting entries between the banks. And this, the Bank of England explains this quite clearly. They say the money-creating sector in the United Kingdom consists of resident banks and building societies. Money-creating organisations issue liabilities that are treated as a media of exchange by others. And those liabilities are the numbers that you see in your account. Now, what this has meant is with the sort of rise of electronic means of payment is that we've reached the point where...
And most of the money in our economy, broad money, comprises liabilities of banks in the form of bank deposits.
So most of the money in our economy comprises liabilities of banks in the form of bank deposits. This is, when we talk about 97% of the money supply being created by banks, this is what we're talking about. So this chart of the blue line is the bank-issued money supply. This is cash down here at the bottom. So the 3% here, this is 3% of all the money that exists. And then this is the 97% of the money supply that is created by the banking sector. And this 3% is what is covered by the law. And this is the 97% that is ignored by the current laws. So I always found it curious that there's this one part of the state, the police, which is responsible for hunting down and prosecuting anybody who prints their own money privately, or they call it counterfeiting. And yet there's a whole other part of the state which actually has more resources and more funding to do everything possible to encourage banks, private companies, to create money. And I could never really understand why this contradiction was there and why it was good for electronic money to be created by the private banking sector, but bad if anybody's printing paper money. Now, I stumbled across this interview with Paul Fisher on the BBC.
When you start printing money, you create some value for yourself. If you can issue £1,000 worth of IOUs to everybody, you've got £1,000 for nothing. And so we do restrict the ability of people to create their own notes in that way.
You're protecting us from ourselves?
We're protecting you from charlatans.
So he was talking about counterfeiting, but for me the key phrase is this: if you can issue £1,000 worth of IOUs to everybody, you've got £1,000 for nothing. Now what banks do when they make loans is they issue liabilities, IOUs. In the last 10 years alone, banks have issued more than £1 trillion of these new IOUs, these liabilities. Now the something that they got for nothing was £1 trillion worth of debt, of interest-bearing contracts. And this is mortgages, personal loans, business loans. This is debt from us to the banking sector. And as you've seen this morning, the total interest that has to be paid on that debt is a transfer from society to the banking sector of between 108 billion to 217 billion every single year. Now, of course, some of this comes back to people through the interest on savings accounts and through the bonuses and the commissions and the taxes that banks pay. But it's still, a huge amount of this is creamed off in the middle. And it's a massive transfer of wealth, and it leads to, it exacerbates inequality. Now, I think the economists and the people in government who defend this system and say it's something we should keep and it's something useful, I think they do so because they believe it can be controlled. And they believe it can be controlled because they're taught certain stories in economics courses about the money multiplier and that the central bank has control over how much money there is in the economy. We really don't believe it can be controlled, and this is one of the reasons why we've settled on this particular style of reform. But the reason it can't be controlled, for a start, this doesn't look like a money supply that has been controlled. This is something that's out of control. But even Mervyn King has said that the Bank of England's key role has always been to ensure that the economy is supplied with the right quantity of money, neither too much nor too little. For 50 years, my predecessors struggled to prevent there being too much, so leading to inflation. I found myself in the opposite situation of having to explain that there is too little money in the economy. So this is the most powerful man at one of the most powerful central banks in the world, admitting for that the last half a century they have struggled to keep the banks under control, to keep the money supply under control. And if you get an admission like this, I think it really shows that the system can't be controlled. The book actually goes into great detail, probably about 60 pages, explaining why the mechanisms that economists believe can control the money supply no longer work. But fundamentally, it's because you have this battle between the desire of the banking sector to create as much money as possible to maximize their profits, because the more money they create, the more they lend, the more interest they receive, and the need of the Bank of England to kind of protect the public interest, to limit inflation and instability in the economy. And these two, for the last 50 years at least, it's been the profit motive of the banks that has won out. So what are the consequences of this? Well, firstly, we know that banks create too much money. They create this money for the wrong things. So we see the majority of money, when it's newly created, it goes straight into the housing market and into the financial sector. Very little, about 13% over the last 10 years, has gone into non-financial businesses. So this is the real economy, the jobs, shops, businesses, and factories, essentially. And about 10% has gone into credit cards and personal loans, consumer finance. And this has led to financial crisis, as Adair Turner said, and as we saw this morning. Some of the headlines that have been coming out of the last couple of days are getting worse and worse. Britain is experiencing a worse slump than during the Great Depression. For a while, we've been talking about, we're in recovery, growth has been 0.1%, and then now we're back into the double-dip recession, and then we're back into recovery again, and now we're back into the triple-dip recession. This is a real roller coaster. Global unemployment will reach a record 200 million in 2013. 200 million people, is there nothing useful for those people to be doing, really, given the situation we're in right now? But there's not enough money, there's not enough numbers in computer systems created by the banking sector to allow those people to do something useful. It's led to massive indebtedness because money is created by banks when they make loans, so as the money supply goes up, the debt goes up as well. And then house prices, an entire generation has been priced out of being able to buy a home. The inequality that we discussed, the instability, which is really, really bad for business. You'll always hear economists and lobbyists for the banks saying that the current banking system is good because it provides credit for business and helps the economy to grow. But actually, we believe that on net, this current banking system is really harmful for the business economy and for actual wealth creation. It's very environmentally destructive, as we talked about this morning. And it's bad for democracy as well. The banks now have more power to shape the economy through their lending than the whole of government. But we have all these MPs scrutinising what the government does, and only about 80 board members paying attention to what the banks are doing. And the reason that the system's got to this point is because every time something's gone wrong with the current banking system, the government has stepped in with a safety net or a new support measure to allow the system to continue. And you've seen this at its most extreme over the last sort of 5 or 6 years. Now, I want to make the point that this is, as some people assume that if the banking system is structured in a certain way, it's because some wise men have sat down and designed it. But the current banking system is, without getting into the evolutionist debate here, there's no signs of intelligent design in the current banking system. It's evolved over time, and every time there's been a crisis, there's been some new package from the government, some new measure from the Bank of England, and things like the bailouts, the funding for lending, all these different schemes to keep the system going. Now, sometimes evolution works out really well, and you get something that's quite beautiful and efficient and effective. Sometimes it doesn't work out that well, and there's no prize for guessing which of these two fish represents the banking sector right now. So the thing is, if you build your house on sand, it's going to collapse. This is what we have at the moment. We have a banking system that is really built on sand. It doesn't matter how much reinforcement or how much support you do. It's not enough to go to the occupants and say, please tread lightly while you're inside the house because it's a bit unstable. And if you could lose some weight, that would be great too. You have to wipe it away. You have to start again and build something on firm foundations from the ground up. And this is what we believe we're doing in the book here. So we have this very dysfunctional system that isn't really working in the interest of the economy or in the interest of society. And my colleague Andrew Jackson, who's done by far the largest part of the work on this book, found this quote, which I think really sums up part of the ethos behind the book. Our problems are man-made, therefore they may be solved by man. No problem of human destiny is beyond human beings. The monetary system is just a collection of rules and laws and computer systems, and it's actually remarkably easy to change. The real challenges are the things like the environmental crisis, the water crisis, the energy crisis, the changes that we're going to see over the next 40 years, the growing population. Those are real, tangible problems that we need to find real practical ways of dealing with. This is just an artificial monetary system. It's a computer system. So we can't let ourselves be distracted from those big challenges by this artificial, broken, dysfunctional monetary system. So what do we do? Well, I'll take you through these quickly, and then we'll go into a bit more detail on each of them. First thing is that we need to remove the power of banks to create money. We need to return that power to a transparent and accountable process. We have money created free of debt. We create money only when inflation is low and stable. We make sure that any new money goes into the real economy instead of into the financial markets and property. And we give us, as customers of banks and as members of the public, control and transparency over how our money is actually invested. First one, removing the power of banks to create money. Well, I don't want to take you through all the technical details of how this is done. It's explained quite simply in the book, but we'll also be releasing in the next month a series of videos that go through step by step if you prefer to see things visually. But just a quick overview. As I said, banks currently have the power to create money because the liabilities that they issue are the money that we use in the economy. So money-creating organizations issue liabilities that are treated as media of exchange by others. We use these liabilities to make payments to each other. In the current system, we're here using the liabilities of these banks to make our payments. And what we do through the particular reforms outlined in the book is that we actually start using money that is created by the Bank of England. So instead of you using a promise to pay from a bank as your way of paying somebody else, you're actually using real electronic money that is being created by the Bank of England. What this means for you as a customer of a bank is that you have two options when you get your salary. You can either say to the bank, look, keep it safe for me, or you can say to them, I want you to go and invest it for me. I want to get some interest. And if you say you want your money to be kept safe, then this would be put into a transaction account, which is effectively the same as a current account now. But the difference between a current account and these new accounts is that your money would actually be at the Bank of England. It would be electronic money stored electronically at the Bank of England. And that would actually be yours. It wouldn't be the bank's. They wouldn't be able to play with it, to invest it, to do anything with it. This investment account, what you're actually doing there is you're giving your electronic money that was created by the bank, Bank of England, to your bank so that they can then go and lend it to somebody else. And what this does, through the fairly simple rule changes and a few accounting changes, this makes banks into what people think they are now, which is intermediaries, middlemen between savers and borrowers. They after this reform, what banks will be doing is taking money from savers and investors and actually lending it to borrowers, doing exactly what people think they do now. So with banks no longer having the power to create money, we need to return that power to a transparent and accountable process. We know, I'm sure like everybody is here because they know that we can't trust banks to create money for all the reasons that we've discussed. But I guess you wouldn't trust these people either. Because the problem is that politicians have the same incentives to abuse the power to create money as the banks do. The more of it they create, the more of an artificial boom they can create in the economy to get people to vote for them. And that's it's gonna end up badly. So what you need to do, the absolute key thing that needs to be done, is that you have to separate the decision over how much money is created and what that money is used for. Because as soon as the same person or the same organization is making those two decisions, you have a conflict of interest. So what we've suggested is that a new committee, the Money Creation Committee, which would replace the Bank of England's Monetary Policy Committee, becomes responsible for deciding how much the money in the economy needs to increase or decrease by. And the government would be responsible for actually deciding how to get that money into the economy. The really important thing is that you make sure that this Money Creation Committee is sheltered from lobbyists, either from the elected government of the day, who will have their own objectives for what they want the economy to do, which might not line up with the best interests of the economy, and from the banks as well. So this whole process needs to be transparent, accountable to Parliament, but we can't have George Osborne calling up the Money Creation Committee and saying, can you put another £100 billion into the economy because I really need a recovery before 2015. Then you need to make sure that money is only created when inflation is low and stable. So let me show you what happens with the current system. So banks increase their lending, which means they're creating more money.